I'm Marc Purintun, and I'm the head of the Employee Benefits and Executive Compensation Practice Group here at Williams Mullen. For today's agenda, first we're going to hear from Brydon Dewitt. He's going to be speaking about the Secure Act and extended deadlines and those that didn't get extended, as well as the Secure Act 2, which is proposed legislation. Then we will hear from Allison Carlon, our new associate, who will be discussing using retirement plans to incentivize employees to remain employed. And then we will hear from Nona Massengill, who's going to speak about issues related to executive compensation plans and in the current context. And then finally, I'm going to speak about fiduciary duties, plan investments, and some litigation, and a little bit about a new auditing standard that has come about. So the next slide. Okay, before we go on, some housekeeping notes. We're going to be using Slido, which is an online, I guess it's an app, but it's also a website. So in order to use it, we're going to be using it both for people who are in person as well as for people who are joining us online. And you need to go to slido.com and log in and then enter the event code, which is up there, 9000902. And then you'll see two tabs. One is the Q&A tab and one on the left, and the other is the poll tab, which is on the right. And we will be answering questions at the end of the entire presentation. And so you can enter your questions while sitting throughout any of the presentations, and then we will respond to those questions, time permitting, at the end. And we ask that if you ask a question, please go ahead and put your first and last name or your email, so that if we don't get to your question at the end of the presentation, we can respond to you and answer your question that way. Also, we will not be announcing the names of people who sent the questions. So your question, if we discuss it, we will not, call you out on that. If you prefer to ask your questions in person, those who are in person here can wait afterwards, and we'll be hanging out for a while, and you can ask us directly. And if you're joining us online, all of our slides have our contact information on it, and please feel free to shoot us an email or give us a call, and we'll respond accordingly at that time. For remote attendees, if you have any difficulty with the audio or visual portion of the program, please go to the Q&A portion on Slido and send a message to our marketing team, and they will respond directly. And I was told to smile. We hope our in-person and remote attendees will participate in polls. And you can do that by clicking the poll tab, which is on the right side of the question. So a few more housekeeping items. The program is being recorded. I think some of you may have heard that if you were here when it went across. But later this afternoon, we're going to send out an email. It'll have attachments for our presentation slides, as well as a link to the recording. For those of you who are seeking SHRM credit, that same email you will receive this afternoon will contain a link to download your SHRM attendance certificate. The program is valid for 2 hours of SHRM credit. Okay, now it's time for our first poll and test of the Slido system. We've done it a couple times and it looked like it really worked well. But the first question has to do with, who is my employer? So please go ahead and answer the question, both those who are joining us online and those who are joining us in the room. I see several of my law firm colleagues have responded. Privately held companies, we've got some consultants joining us, others. Lots of privately held companies. Consultants, a good group of consultants, publicly held companies. We're going, I think we're gonna, that looks interesting, an interesting mix of both private and public, as well as consultants and others, and a few of us lawyers. So let's go on to the next question. So we get a better understanding of who's actually participating in this. We're going to ask, what is your title at your employer, so we understand where you are. Benefits administrator, director, consultant advisor, HR director, CFO, finance director, general counsel. So that's a really interesting, relatively even spread, it looks like, between people who are active in benefits, who are consultants, people who are HR directors, and CFOs and others. So that is our last poll at the moment. And next, we are going to hear from Brydon Dewitt regarding the Secure Act.
Well, good morning, everyone. I'm not sure, but I think this is the first in-person standing behind a podium seminar that I've done since the pandemic. I mean, it's amazing to think. So I really appreciate everybody online attending and everyone who's here in person for being here this morning. This morning, my focus of my talk is going to be on the Secure Act 2.0. But first, let's talk a little bit about the original Secure Act. The Secure Act was passed in December of 2019. And going into 2020, when all we knew was there was something going on and there's some flu type thing going on out there that they're talking about in the news, and I wasn't really paying attention to, we thought we were really going to be focused on the Secure Act. And of course, we were in administering our retirement plans, but the Secure Act was the big news that we thought we were going to be dealing with in 2020, and things changed. But the Secure Act was passed, and there were administrative changes, operational changes to plans in response to the Secure Act, and the deadline for amending plans was the end of this year. And so until a few weeks ago, we thought that we would be spending a lot of time this fall amending our clients' plans to comply with the Secure Act. However, the deadline was extended until December 31, 2025. So in 2025, we will be amending plans, or you at least have until 2025 to amend plans for things that you started doing in 2020. So, I think although there's an extension to this deadline, it makes sense, I think, to go ahead and start amending plans instead of letting 5 years go by, and personnel at the employer changes, and people are trying to remember what they did and when they implemented a change. I think the sooner the better. We're just not required to make the Secure Act amendments by the end of this year as we thought we were going to. And exception to that, some of the CARES Act amendments were delayed until December 31, 2025. But the CARES Act amendment required by plans that offered a waiver to the required minimum distribution requirements. That still has to be adopted by the end of this year. So let's move on to the Secure Act 2.0. So a lot of the parlance out there is Secure Act 2.0. It's really three pieces of legislation. It's the Securing a Strong Retirement Act of 2022, which passed the House overwhelmingly in March. There's the Enhancing American Retirement Now Act, or the EARN Act, which was approved by the Senate Finance Committee in June, and the Retirement Improvement and Savings Enhancement to Supplement Health Investments for the Nest Egg Act, or the Rise and Shine Act, was approved by the Senate Health, Education, Labor, and Pension Committee in June. Congress consistently gets low approval ratings when they conduct polls, but I don't think people really take into account how Congress excels at acronyms. I mean, it's great. And to think that if that passes, we're going to have to refer to the Rise and Shine Act. We need to make our Rise and Shine Act amendments. So really rooting for that one, just because of the name. So I'm not really breaking out what's in each piece of legislation. Most of it is, I guess, coming from the Securing a Strong Retirement Act of 2022 as we go through these. And also, don't get too excited about these changes, although there's a lot of bipartisan support in Congress. And what we're hearing is we think Secure Act 2.0 legislation is going to pass. Even I'm kind of going through this thinking, oh, this is really great. I have to remember that it's still proposed legislation. Two pieces of legislation have just been, they're just out of committee, right? They haven't even been approved by the Senate. And so we have to see, there could be additional changes to these provisions in the final legislation. So just keep that in mind, that this isn't current law. So I'm not really telling you anything you have to comply with or know just yet. But they're kind of really, I think the Secure Act and the Secure Act 2.0 provisions are a lot of good ideas. In the past, whenever we've had pension reform or pension simplification legislation, it usually meant a lot of headaches that our clients had to comply with, and amendments that we had to adopt to plans and new rules to learn. But the Secure Act and the Secure Act 2.0 it's really a recognition by Congress that our retirement system has changed. We're not relying on the traditional defined benefit pension plan, that employees are relying on defined contribution plans. And we need to get, to the extent we can, we need to make it more attractive and easier for employees to start deferring into their 401k plan, to start saving for retirement. And so a lot of these changes are about getting people into a plan, giving them comfort that they can get money out of the plan if they need to get it out of the plan. And it's, I think, a lot of good common sense legislation. That's just my editorial view of it. So the first change here, the original Secure Act provided that long-term part-time employees who worked at least 500 hours a year for 3 years had to be permitted to defer into a 401k plan. The employer didn't have to offer matching contributions or any employer contributions, but if employees work 500 hours a year for 3 years, then beginning of the 4th year, they have to be allowed to at least make elected deferrals into the 401k plan. The Secure Act 2.0 would reduce that 3-year period to 2 years, and that would be effective after 2022. Student loans. I don't know if you remember, it seemed to me like it was really recently the IRS issued a private letter ruling where allowing an employer to match student loan payments. So employees who are making payments on their higher education student loans, those loan repayments were treated effectively as like elected deferrals into the 401k plan, and then the employer would put a match into the plan. So the employee wasn't necessarily making any contributions to the 401k plan, but the employer was making a matching contribution as if the student loan repayment was an elected deferral. And the IRS, in a private letter ruling, upon which only that employer can rely, approved that arrangement. I looked it up. I thought it was last year that this happened. It was 2018. It was 4 years ago that private letter ruling came out. Some employers started adopting provisions like that based on the private letter ruling, but you really couldn't rely, only the employer that received that ruling could rely on it. Well, the Secure Act 2.0 would codify that, would allow employers to make matching contributions in 401k plans, 403b plans, 457b plans, and simple IRAs, treating the student loan repayment as if it's an elected deferral under the plan. And the legislation really broadly defines a student loan repayment as any indebtedness incurred by the employee solely to pay qualified higher education expenses of the employee. So this is a way to help employees cope with high student loan balances, which is perhaps preventing them from being able to contribute to a 401k plan. Again, these Secure Act proposals are about getting money into defined contribution plans and building retirement savings for employees. So at least they'd be getting the matching contribution that they would be getting if they'd been making contributions to the plan. Catch-up contributions. The Secure Act 2.0 would increase the permitted catch-up contribution. I believe this year it's $6,500. It would be $10,000 for participants ages 62 to 64. There would be no changes for employees ages 50 to 61. And then effective January 1, 2023, and assuming this legislation passes this year, the catch-up contributions would be required to be a Roth or after-tax contribution for employees with wages over $100,000. If you make under $100,000, the employee could choose whether the catch-up is a Roth or a pre-tax elected deferral, I guess, to the extent that the plan allows Roth. Yep.
So would that be like eligible compensation as defined in the plan document, wages, or would that just be
I think it's a set, it wouldn't be under the plan document. It would be their W-2 wages. You couldn't define your way out of the rule, in other words. The question is whether the $100,000 limit would be based on the plan's definition of comp. It would be based on the definition in the legislation. Again, with the goal of getting employees into plans, any new 401k or 403b plan established after 2023 would have to have an automatic enrollment feature. The deferral rate would be between 3 and 10% with escalation of 1% each year. This would not apply to existing plans. So if you don't have automatic enrollment now, you wouldn't have to amend your plan to adopt it. Employers with 10 or fewer employees, small plans would not have to adopt it, and governmental and church plans would not be subject to this rule. The involuntary cash out limit would be increased from $5,000 to $7,000. And as you probably know, the Secure Act increased the required beginning date age from 70 and a half to 72. The Secure Act 2.0 would gradually increase that age, 73 starting this year, 74 in 2029, 75 in 2032. And again, as I was saying, part of the goal of the Secure Act is to get people into plans. And one way to do that is give them assurance that if they need money out of their plan, they can get money out of the plan. And so the EARN Act would allow distributions up to $2,500 per year to pay for long-term care insurance premiums. And there would be no 10% early distribution excise tax on those distributions. And this would be effective 3 years after the enactment of the EARN Act. The Secure Act would allow matching contributions to be treated as Roth contributions. So the money would go in after tax, and then the money would come out with earnings also without tax-free. Congress saw how well the coronavirus-related distributions, or at least they believe the coronavirus-related distribution process worked with employees self-certifying that they were entitled to the distribution. And so that concept would be extended to hardship distributions where employees could self-certify that the hardship event has occurred. 2 more new penalty-free distributions from 401k plans. An employee would be able to take out, or a participant would be able to take out the lesser of $10,000 or 50% of their account balance on account of a domestic abuse that they self-certify. No 10% early distribution tax. And like the coronavirus-related distributions, they'd have the opportunity to repay the distribution back into the plan over a 3-year period. Similarly, a participant who has an emergency expense, they could take out $1,000 per year for unforeseeable or immediate financial needs relating to a personal or family emergency expense. So this would be broader than the current hardship distribution events. No 10% early distribution tax, and also the participant would be allowed to repay this distribution over a 3-year period. Understanding that as employers are being encouraged to have automatic enrollment and new plans are required to have automatic enrollment, it creates an opportunity for there to be an operational failure. So especially with larger employers with employees in multiple locations, the fact that somebody was hired and should be automatically enrolled in the 401k plan might not get back to HR or to the plan administrator. And so that causes an operational failure. So if the plan provides for automatic enrollment and then employees who should be automatically enrolled are not automatically enrolled, that's a elective deferral failure. You're failing to implement or operate the plan in accordance with its terms, and that's a qualification error if it's not fixed. So the IRS could come in on audit, discover this, and you'd end up in audit cap, and it's a bad situation. And so that's really one of the concerns I've always had with automatic enrollment, is that it's easy for errors to happen when you have automatic enrollment. So the Secure Act 2.0 recognizes this fact. And so if you catch the error and you correct it up to 9.5 months after the end of the plan year in which the error occurred, you can correct it with no penalty, and you save your plan from having a qualification error. So there's already in the EPCRS, there's already specific guidance in the appendix to the EPCRS that regarding automatic enrollment that makes it easier to correct automatic enrollment failures. but not this season. This is a even extended deadline to correct an automatic enrollment failure. So I think it's really thoughtful that if we're going to require automatic enrollment, that Congress is giving us the ability to correct errors and issues that could happen as a result of having an automatic enrollment provision. Another issue that comes up often in the case of defined benefit plans are overpayments. And it's a really sticky situation because the plan has not been administered in accordance with its terms. That is a qualification error that risks the qualification of the plan for everyone. It has to be fixed, but you've already paid out. You've already told an employee they're entitled to this money. You've paid out their benefit. They received an overpayment, and now you're supposed to ask for the money back. And now they've purchased a boat, and they're halfway. They're in the Caribbean somewhere, and you're not getting the money back. And sometimes it requires an employer contribution to the plan under certain circumstances. The Secure Act 2.0 would allow plan fiduciaries to not seek recovery overpayments mistakenly made to retirees. And then the other issue as well is if you've overpaid somebody, let's say you've made a distribution for a 401k plan, you've made an overpayment of their benefit, and they've rolled that into an IRA. Well, the amount of the overpayment is not an eligible rollover distribution because they never should have received it. So that's a problem for the participant that they have money in their IRA that doesn't belong there. The Secure Act 2.0 would treat the overpayment as eligible to be rolled over. So it doesn't mess up so you don't have to get the money back. I guess it's no harm, no foul, except that, the plan overpaid someone. And this might be my favorite slide. It seems like whenever Congress passes employee benefits legislation, they're always adding another notice requirement. And we know how plan participants love getting notices and how they just read them really closely and take notes in the margin. And that's what I imagine as we were drafting them, that this is something that people are really paying attention to. But it's a way, really, employers can get tripped up if you miss a notice or you don't have the right terminology in a notice. It's like a landmine. And there's all of these notice requirements. So with the Secure Act 2.0, Congress will be directing the IRS, the Labor Department, and PBGC to review all of the current reporting and disclosure requirements and make recommendations to Congress to consolidate, simplify, and standardize all of the notice requirements, which I think is an outstanding idea. And the Secure Act 2.0 would eliminate the need to send unnecessary notice to unenrolled participants. So you have employees who did not enroll in your plan, they're not participating in your plan, they're not making elective deferrals into your plan. You wouldn't have to send them all of the notices. There would still be certain notice requirements like the annual opportunity, letting them know they have an annual opportunity to enroll, and then certain documents that they can receive upon request. But these two provisions would really make life easier for plan administrators and HR departments to not have to, if we can consolidate the notices, all of these notices that we have to issue, and then eliminate unnecessary notices. I think that's why this is my favorite slide. And so now that's Secure Act 2.0. That's me. And so now I'd like to turn to Allison Carlon, our newest colleague on our employee benefits group. And Allison is going to talk about using retirement plans to attract and retain employees.
All right, thank you so much, Brydon. And I will note, we don't have any breaks built into the schedule today, so if you have to get up at all, feel free. I won't be offended on there. All right. So as Brydon mentioned, my name is Allison Carlon. I am a new associate here in the Employee Benefits and Executive Compensation Group. I also sit on the board of the Central Virginia Employee Benefits Council as well. So I graduated from Georgetown Law School just last year as I left behind my prior life in human resources. So you may see some of that slip in to my slides here. But today I'm going to focus on attracting and retaining talent through employee benefit plans, mainly through 401ks. All right. Okay. So I think most, if not all of you, would be aware, at least anecdotally, of the tight labor market here in the US right now. There's an ongoing battle to both attract and retain talent. Much of this comes from one, low unemployment rates, but that combined with more workers leaving and choosing to forego traditional employment, as well as in order to go to really like gig work, part-time, a few different areas, as well as a reshuffling of talent across industries as well. All of this has continued to build into significant labor shortages. This has been coined the Great Resignation. It started in about spring 2021, and has, at least through 2022, stabilized somewhat. We're still, though, right now at a high over pre-pandemic levels right now. Let's see. So other reasons that we're seeing some changes, though, in the labor market and some of these heightened demands. We have a younger generation that's coming into the workforce right now who has additional demands in terms of what they believe is important to them. They want to have a little bit more control. They also have realized that they have greater bargaining power right now. So a lot of this is driving both the labor shortage, and then the new generation coming to the workforce is driving these shifts for us. But at the same time, we have to keep in mind that all of these changes, not only are they costly in terms of having to attract and retain, you're going out and doing this search, but there are hidden costs to this turnover that we should take into account, right? So you may be thinking employee benefit plans, these are expensive to maintain, they're expensive to improve, but it's also expensive to lose talent. And in this market, it's hard to keep that talent. So other costs that can impact that cost of turnover. So we have our cost of attaining that employee, the job search, you have training, but then you also have the cost to any disruptions in productivity that may occur that can be caused from loss of morale within the workplace, as well as disruptions to your client base, right? People don't always leave on a pleasant note on there. And then you lose experience and institutional knowledge as well when you have these turnovers, which will set you back. Oftentimes, apologies, I lost my place. All right, so what does this actually cost? Conservative estimates place the cost to replace an employee at anywhere from 1/2 to 2 times their annual salary. As a whole, that sets us, US businesses, it costs about $1 trillion per year just to cover these costs of turnover that we have. So clearly, I think no business wants to have to go through this process. They also don't want the cost of replacing this talent on here. So how do we attract and then retain that talent so we don't suffer these other issues with our businesses? So recent studies have shown that about 64% of employees said that a significant increase in pay or benefits was very important to their next job. And then 61% indicated that work-life balance, as well as well-being, personal well-being, were going to be important and significant factors in their next job search. All right. So as we're thinking about why it's important to retain talent and how we can do that, I want us to do a quick poll that you can respond to on Slido. Here we are. So thinking about yourself as a worker, how would you rank the following benefits in terms of importance to your life? For this question, I'll ask you to rank the benefits. You can click on them in order 1 to 5 or drag and reorder them as needed. Please just remember to hit the green button to submit your answers. All right. I mean, I don't think it's surprising that we're seeing retirement pull ahead due to the nature of this forum here. All right, health insurance. So let's see, I'll give it just a few more seconds to see if anyone else comes in. Might be at a little bit of a three-way tie for us. All right. I mean, as we can see here, one, health and welfare insurance, they're just must-haves that you for maintaining a workforce, right? But financial security and personal well-being are taking the stage. Oh, did I push the right button? Yep, there we go. Are taking the kind of main stage with current cultural and societal demands. I'm going to focus today on 401k plans, as I mentioned, as opposed to these others due to the nature of the forum. So numerous studies have shown, and I'm sure that many of you have seen, that workers highly value not only the ability to contribute themselves into a retirement plan, but also to receive employer contributions to those plans. About 62% of workers say that a plan match is important to them being able to meet their financial goals. Almost half of all workers consider a match to be an important factor when deciding whether to accept a job, which is fairly high. And if you're trying to recruit, that could be a pretty decent success or failure rate on there. One note for profit sharing contributions. These type of employer contributions can create a significant benefit for employees. Employees as a whole, though, tend to not be as familiar with profit sharing contributions to recognize the value that's provided to them on here. So this is an instance with profit sharing contributions where financial education is a great starting point to help your employees recognize the value of a benefit that you may already be providing to them and help you with training them. I'm going to mix up all my words, attaining and retaining them on this point. All right. Okay. So I promise this is my last poll for you. All right. If your organization has a 401k or similar plan, which of the following are features that it includes? You can submit one or more answers, but remember to click the green button. So you have matching employer contributions, profit sharing contributions, no employer contributions, or you don't have a 401k plan. All right. And this, as we're coming through, lines up, a lot of data says that about 92% of employers with a 401k plan offer a match. That's pretty high. So if you aren't one of those employers already, the competition is pretty stiff for you. All right. So I'll take a step back for a second. 401k plans, once again, I'm focusing on this because they are one of the most common and most well-known retirement plans that are offered through employers right now. So they're great in that they can be designed and modified to appeal to current or future demands that you may see. As Brydon mentioned, there are a number of things in the pipeline that could affect and make these even more attractive plans for them, including the private letter ruling that he mentioned earlier. I won't go into as much detail since Brydon graced us with it before. All right. So how do you design a 401k plan that will attract talent, and what's the market doing right now? So as I said previously, employer contributions are hugely important in designing an attractive 401k plan, whether that is a matching or profit sharing contribution, and whether it is adding or just increasing employer contributions. While the numbers vary across studies, approximately a quarter of employers with existing matches have increased that match in the past year alone. So once again, while we had 92% with a match, additional employers are starting to increase that. So even if you have a match, your numbers may not quite lead up with what we have as market at this point. All right. Another method that you can use is to reduce or eliminate waiting periods for the employee elective deferrals. One way to think about this is if an employee or worker decides to join your company and they have to wait 6 months to be able to participate at all in a 401k, that is 6 months that they cannot contribute to their own retirement savings. It's something that it doesn't cost you on the matching at that point if you do employer contributions, but it still allows them to be able to contribute toward their own retirement savings. So that's something to keep in mind when you have waiting periods, even for the employee elective deferrals. And then you also can reduce or eliminate waiting periods for employer contributions. Understandably, and I'll go into this a little bit more, that can be more costly for you. And so there are other methods to try to mitigate those additional costs that you can do. Some other ways that plans are being amended right now to attract additional talent. We have expanding compensation options for their deferrals. So instead of just using their basic compensation, you can include bonuses as well and other types of compensation for them to make deferrals. On there, we also see an increase in adding or enhancing the automatic escalation or automatic enrollment features as well right now. All right. So understandably, with kind of an uncertain economic future, a lot of employers are hesitant to tie up money with these plans, right? With a potential or probable recession on the way, it's understandable that you may want to hedge your bets a little bit on this. So there are a few different tactics you can use to try to manage those costs. The first one being to stretch your match. So while a company may, for example, have a 3% match that they do, there's a lot of text up there for you. A 3% match, instead of matching all 3% right on the first 100% of their first 3%, you could instead split that up. So instead of 100% on 3%, you could do 50%, or you could do 100% on the first 2% and then 50% on the next 2%. What that does for you is it makes it so for an employer or an employee to get the full matching contribution, it would then take them deferring a full 4%, which has two benefits. One, it can help you manage some costs, but it also encourages additional savings for your employees as well on there. All right. And this is done as well with going even from, instead of staying at 3% for both, you could end up doing a total 6% match, but it's spread out over a greater period on here. You can also add vesting schedules, right? So if you're concerned about somebody coming and you spend a lot of money on them and you're investing in them and then they leave pretty quickly, you can add a vesting schedule onto future employer contributions. And that also encourages the retention that we're looking for here. All right. So what else can you do? So Schwab survey earlier this year showed that 41% of workers are also looking for a health savings account, and between 20 to 23% want some other sort of financial advisement. They want financial services to help them with their financial health on here. All right. All of these further underline really the importance of helping workers to develop their long-term financial security. A quarter of workers indicate that financial stress impacts their work. So not only do these programs assist with attracting and retaining talent, but it also assists with engagement in the workplace and productivity as well. All right. So last up for me is I'm just going to touch on health savings accounts or HSAs quickly. A lot of times we may think of this as just a health benefit, but it really is a savings tool for the future for your employees. It allows them to have access to these funds now for health expenses, concerns that may pop up, but it also creates a pool of money that they can use in retirement as well. For this, employers can also contribute to HSAs, as many of you may be aware on here, and that's separate from your 401k match on this, on there. So, all right, if you have any questions at all, you can submit them through Slido. I will be here after as well. And I will turn the time over to Nona Massengill partner here.
Great, thank you, Allison. That was great. And I think maybe as an introduction, I will pick up a little bit on Allison's theme of attracting and retaining talent. So I'm going to be talking about non-qualified retirement plans today. These types of plans are more flexible, even than the flexibility that Allison described, and can certainly be used as a means to attract key employees, retain them. Sometimes it's discussed in negotiations for a high-level hire. So they're very important and flexible. We're going to talk about some of the basic principles of non-qualified plans today, as well as some administrative, I guess I would say, concerns or issues that I've seen pop up quite frequently over the past couple of years. Nothing to do with changes in the law, just something that I've seen frequently that I would like to share. All right, so what are non-qualified retirement plans? They go by many names, and so I just want to sort of describe what falls under that umbrella. You might hear them referred to as SERPs. Deferred income plans, deferred compensation plans, elective deferral plans, supplemental retirement plans, the names go on. Also, 457 type plans. So we've got 457B, 457F. Those are for particular types of employers, and we'll discuss that later in this session. And they can involve employer contributions, employee elective deferrals, or both. And they can certainly grow, and in some cases they're structured to mirror 401k plans. So we'll talk a little bit there about how record keeping and fund selection and opportunities come into play. Even though these plans are called non-qualified plans, they are still governed by laws. And not surprisingly, those laws are Erisa and the Internal Revenue Code. There are fewer Erisa provisions that apply. We'll discuss that. But the Internal Revenue Code, sections 409A and 457, prescribe a lot of rules about the timing of elections and payments, even if it's only an employer-funded plan. So we'll get into that as well. All right. So I might have just talked about funding or funds associated with a non-qualified plan, but for tax purposes, these plans need to be unfunded. That is really another aspect of these plans that offers flexibility. The plan can be solely a bookkeeping record where it's sort of pay as you go, and the employer simply at the time the plan prescribes payment comes out of pocket operating and just an operating expense and pays for expenses at that point. They can also be supported by a trust, often referred to as a rabbi trust, sometimes insurance policies, especially with, I see that most often with SERPs, where the benefit is controlled by the employer, or I'm sorry, the benefit timing is controlled by the employer. Often the employer chooses to purchase insurance to give itself a source of assets with which to pay benefits. All of the any type of funding associated with these plans remains an asset of the employer. So it is on the employer's books as a positive. Sometimes the funds match exactly the liabilities under the plan. Other times they may exceed the liabilities, certainly the vested liabilities. So that's just certainly behind the scenes, but one aspect to think about in designing and administering a plan is how are you going to pay for this? Because often, and by design, the payments are going to occur many years in the future. One question that I get quite frequently, sometimes from executives, most employers are familiar with this, but is whether distributions from these types of plans can be rolled over. Just to be very clear, for anyone here who works in an advisory capacity, I'm sure you're familiar with this, but to ensure that participants know, distributions are taxable when received. And there's a slight variation on that for 457F plans for tax exempts. We'll talk about that. In that case, taxation could occur before amounts are received. Kind of want to avoid that, but there's no ability to roll over to an IRA. Not a bad thing. It's just part of a retirement mix for a given employee. I look at it as diversification in another way, because people have a lot of planning opportunities with their qualified benefits. And this is something where, depending on the plan, people have some degree of choice when to take a taxable benefit into account. Maybe it's college expenses. Maybe it's, I know that I want to retire at 62 versus 65, whatever. So that's just a general principle. All right. These types of plans must be limited to a select group of management or highly compensated employees. This is one of the points where I've said that over the past couple of years, just by coincidence, this has come up a lot. And it could be because there is a desire in the market to provide additional incentives to attract and retain employees. Employers may want to go deeper into their employee population with these supplemental type benefits. That is tricky. And the reason why is that Erisa requires, because these plans don't have a trust, because they are not subject to the typical vesting rules, nor are they subject to the broad-based participation requirements as qualified plans, they really can't comply with most of Erisa's rules for, say, a 401k plan. Therefore, in order not to run afoul of Erisa, the population that can participate in the plan has to be this select group. What is a select group? Well, naturally, there's no safe harbor. So that's when, again, for anyone who's an advisor, you want to have conversations with your client. For anyone who is an employer, you want to think hard about who should be in the plan. The slide showed just some, those numbers come from court cases, but they're older cases. There really isn't, and there have been a few recent cases, but nothing definitive. One thing that I noted in a fairly recent case is that, if you're trying to limit the group to, say, 10% of the employee base or 7% or something like that, there's not really even any assurance that an employer, like a holding company with multiple subsidiaries or multiple commonly controlled groups, there's no confidence that you can necessarily look at all of the related employers as the denominator in choosing your select group. So again, this is, before you get too far down the road, it's important to really focus on who the group is that will receive this benefit. I will note governmental employers are not subject to Erisa, so this particular concern is not present. All right, so is my plan a retirement plan? This is kind of the flip side of having to strive to maintain just a select group of participants. If your plan is not a retirement plan, then for Erisa purposes, you won't have to deal with this select group rule. But let's talk a little bit more about why does it matter if my plan, my supplemental, incentive, SERP, deferral, this, that, other, any permutation, is it a retirement plan? Well, why does it matter? The select group and unfunded features have to be present. annual reporting requirements that can be done very simply for non-qualified plans, but there is a simple filing that would apply if you're a retirement plan. These are referred to as top-hat filings, made within 120 days of establishing the plan. It's simple, it's online, talk to your advisors or counsel. And there's a really simple thank you corrective process. It's $750 for all of an employer's plans. So a self-audit is not a bad idea. Sometimes, because in the past, these were not done electronically. So there's a lot of times when, yes, a letter was mailed in, but it was in, 2000. Nobody has a copy of that letter. So anyway, there's an easy correction, and that's one of the consequences of being a retirement plan. I'm asking it again because it is really, this is a key question that I've come across recently. Is my plan a retirement plan? Because these types of incentives can take so many different forms, it's not always clear that a given plan is a retirement plan. A lot of times, especially for privately held entities, I see plans that are, they may be focused on a transaction. It's a transaction payment plan, but the employer also wants to provide some sort of benefit if someone retires before a transaction occurs, or on death or disability. And then perhaps the employer, for cash flow reasons outside of a transaction, wants to pay in installments on, say, retirement. So you have many concepts built into a single plan. And when you look at the plan as a whole, it becomes a lot more gray or even lean retirement as to the characterization of the plan. So those are the types of questions that I normally ask clients. Is it essential to you to pay in installments post-employment termination? If so, it looks a lot more like a retirement plan. Is the plan, can you focus your plan solely on a transaction event? If that's the case, then, and it's paid out right after closing, or subject to just earn out, something like that, where the purpose clearly is not retirement oriented, then you might have more comfort that you don't have to worry as much about the select group and you can offer to more folks. Other considerations are just the other way of looking at that is where people are vested and employers are trying to be generous. They say, well, we want people to vest, and if they die or become disabled, we want them to hang on to this incentive, and it's going to be paid, at a certain future point in time. That no good deed goes unpunished. That makes it look more like some sort of retirement income. So these are just factors to be considered at the outset in design. Okay, so this slide relates to another administrative issue, best practice, just point of discussion that we've seen a lot lately, and it's very understandable, very common, but sort of self-audits could be super helpful here, or for advisors working with your clients just to sort of prompt a self-audit from time to time. So one type of non-qualified plan is an elective deferral plan, where individuals, just like a 401k, but with a few more restrictions and timing, choose to defer some portion of their income into the plan. Sometimes it grows with deemed retirement funds, and then it's paid out in installments and a lump sum. It can be paid at an age, it can be paid on retirement, it can be paid on death, it can be paid on the first to occur of, it can be paid on a change of control. Lots of choices. And a lot of plan documents because I think there's a desire to give as much flexibility as possible. This is a different plan from the 401k or the pension. We want to give people that choice to say, like I mentioned before, okay, I know when kids are going to be going to college, let's, set up for a distribution then. I want a lump sum in 2026. Okay, great. But the plans that offer that much flexibility often allow people to make different choices each year. So when you make your deferral election in December of 2019, you chose a lump sum for the amount you deferred for the coming year and earnings thereon. Then you get another form electronically or physically at the end of the next year. You get to make another choice. Some people, well, not some people, I mean, it's just because of changes in circumstances or just a change in thinking, or they forgot what they did or whatever, there might be a different choice for the next year. Okay, that's great, that's fine. 409A allows that, it's okay. However, on the other end, there has to be some sort of system, tickler, perhaps a third-party record keeper to help keep track of all of the participants and each year's deferrals and when timing is going to occur for the distribution. So it can be tricky, and it's really just a matter, I say just, it's a lot, but it's a matter of record keeping. And almost with this type of plan, no different or really, have a parallel system to a 401k plan. But, for any 401k plan or any type of plan that doesn't, qualified plan that doesn't allow in-service distributions, you have even a different layer because these plans can allow for in-service distributions. So anyway, it's just really, systems, self-audit, third-party assistance can be beneficial for employers, something to be aware of. All right. FICA taxation. This is, I mean, we could spend 20 minutes on this alone, but generally the rule for FICA taxation is that FICA taxes are due for non-qualified plans when service requirements and vesting conditions have been satisfied. So this may well occur before payment. So there can be a FICA recognition, very much in service, but not necessarily at the time. Well, elective deferrals are going to be vested, but any type of employer match, I mean, that could occur 3 years after the person became a participant, but many years before they received their benefit. And the really good thing about this rule, so it's not just another thing to keep track of, once amounts are properly taken into account at the time of vesting under this rule, future earnings, deemed earnings, but future earnings on those amounts are not subject to FICA. It's not just a deferred payment of FICA, they're not subject to FICA. So it can't be both for the employer, because the employer has an obligation too, and the employee. It can be a true dollar savings to observe this rule, properly. Probably because there are some gray areas, especially when you have a defined benefit type of non-qualified plan or sort of complicated vesting rules or uncertainty as to when a benefit will start, if it's truly a retirement-based commencement as opposed to an age. There can be some analysis of the regs that is beneficial to discuss with your advisor or counsel, and also just to ensure that your plan is, I will say, both subject to and eligible for this rule. This rule. Some types of plans that are put in place shortly before somebody retires don't qualify. Some equity-based arrangements, not a stock option, we probably know that, but equity-based arrangements might not qualify. But anyway, it's just something that it's really just issue spotting for today, but know that that's out there as a feature that could be a little different than normal, just payments of salary and bonus. All right, so 457 B and F plans are for, they most often, you will see these for non-tax exempt employers. And they're beneficial. I think I skipped a slide. Yeah, all right. They can offer, so these types of plans are maintained not by sort of for-profit businesses, but they're maintained by other employers. And 457Bs are, and I will put in a caveat here that Mark, feel free to correct me. Mark, this is very much one of Mark's focus areas, but because they're non-qualified, I deal with them as well. But 457B plans are very helpful because while they're limited in an amount that can be deferred under these types of plans, there's more flexibility in terms of effective deferral of income recognition. This vesting rule that I mentioned in terms of FICA, a similar rule applies to 457F plans, not B plans. So 457Bs are very useful for tax exempts that want to offer something in addition to their qualified retirement plans. That might be like the first line of offering to supplement available comp to their employees. I would also say that, as I mentioned, that the sort of FICA-esque rule does not apply. So a 457B can be vested, but not taxed until distribution, and the distribution timing elections are the choice of timing for payout under the plans is more flexible than a 457F. For F plans, I'm just going to call them F plans, they result in taxation at the time the amount becomes vested. Positive of the F plans is that, unlimited amounts of employee or employer money can be accrued under these plans. So they're in amount, they can be much larger. We often see them for the very top executives in, say, a healthcare system or something of that nature, where you really have highly compensated executives that need additional incentives to be on market with their for-profit peers, but but they're in a nonprofit environment, and so the 457Fs are offered there, and it's just very important to make sure everybody's aware of the taxation timing rule, the vesting, because there's a little bit, sometimes non-competes can defer vesting, big asterisk, those, it's important to vet that, but it's really key to, in these types of plans, to say, what are the conditions as to which the employee is subject in order to be entitled to the payment. And you can stagger vesting. So, an individual doesn't have a big hit, boom, this whole balance is vested the minute you retire. You can stagger around a projected retirement age for tranches of the benefit. So there's flexibility here, but, as with everything, particular rules that apply. Top hat filings, that simple filing that I mentioned in lieu of annual 5500s, they also are applicable to these types of plans. And, Yes, that's me. Just as Brydon said. All right. So that is all I have. I'm going to hand it over to Mark now. And thank you.
Thank you, Nona, and for the other people who have been giving presentations. Just one flip back to what Nona was saying about 457 plans. 457 plans are generally only applied to tax exempt entities. There's some carve outs. So 457B plans maintained by a governmental employer are tax favored plans. They're like a 401k plan. Employees can elect to defer into it. It's got to be held in the trust and it's not executive comp. 457 plans cannot be maintained by churches. And the definition of that is squirreled away in a couple different provisions in the Internal Revenue Code. So if you have a really beautiful 457 F or B plan that you've drafted for a church, make sure you go and look at that and make sure that the exclusion of churches for 457 doesn't apply to your client or to your organization. With that said, we're going to go on to the much more fun topic of fiduciary duties. And so again, I'm Marc Purintun, and I'm a partner in the Employee Benefits and Executive Compensation Practice Group. And my practice focuses primarily on retirement plans, tax-favored retirement plans, 401k, 403b, 457b plans, as well as executive compensation. And I do a lot of work with governmental employers, church employers, tax-exempt entities, colleges, universities, et cetera, as well as a whole smattering of public and private employers. So that's my practice area. And now we're going to talk about one of my favorite topics, which is fiduciary duties. So on to the first slide. In this time of market uncertainty, there are a lot of people who are very concerned about their retirement accounts. They're about to get their, maybe they recently did get their second quarter statements that showed some losses. The third quarter statements may also show additional losses. And so that causes a lot of concern on the part of participants as well as plan fiduciaries. And during and following the market downturn that happened in the mid-2000s, there was a lot of litigation that happened in and around that time. And that occurred mostly because participants were seeking a way to recover from some losses that occurred. And if they could find a way to hold fiduciaries responsible for those losses, then they could get their money back or get some of their money. There were a rash of what were known as stock drop cases. Those are cases in which the employer's 401k plan held within the plan employer securities or employer real property. And those are sometimes referred to as ESOPs, which are employer stock ownership plans. Also, there were a lot of cases that involved participants suing fiduciaries because of the fees that are charged under the plan. And as a result of that, they were claiming the fees were excessive and sometimes the funds were imprudently included in the plan. And as a result of that, the fiduciaries had breached their duty and therefore must make the plan whole. Similar cases are occurring now. Surprise, surprise. And there's two cases we're going to look at from this year and two cases we're going to look at from mid-2000s that are going to highlight this, which is why we thought it would be really important to talk about, we're in this economic period of flux. Hopefully inflation is not going to last forever. Hopefully the markets will go up again. I believe it, but we'll see. And my investment advisors tell me that all the time. We will see. I see you smiling there. Anyway, what I'm going to cover today is Erisa fiduciary duties in general, and then specifically talk about the duty of prudence as it relates to monitoring the investments that are in the plan, as well as the duty of prudence that is involved with respect to when employer securities are in the plan. And then at the end, we're going to talk about a new accounting standard that is applying for plans that have that are subject to the accounting rules. And we'll go into that in greater detail at the end. So Erisa, not surprisingly, has its origin in financial crisis. Back in the early 60s, Studebaker Automobiles went into bankruptcy. And not long after they entered into bankruptcy, it was soon discovered that their pension plans were underfunded. And so much so that a plan was created that people over a certain age were going to get the whole amount. People less than that age, I think less than 60, were going to get a lump sum payment of a fraction of what they had accrued. People under the age of 40, nothing. So that created quite a stir because thousands of employees and former employees were going to lose a large chunk of their benefit or get no benefit at all. After 10 years of investigations and negotiations and policy compromises, Congress finally passed the Employee Retirement Income Security Act of 1974, which is known as ERISA, which continues to be amended, but that is the basis of what we have today as ERISA. And at the core of ERISA are the fiduciary duties, the duties that the fiduciaries of the plans must follow in order to administer the plan and to address the issues that come before them. ERISA fiduciary duties are based on fiduciary duties that were originally developed in trust law. A little carve out, kind of like the one before. ERISA duties and ERISA in general don't apply to governmental plans. And ERISA does not apply to non-electing church plans. Those are church plans that are from an organization that didn't elect to be covered by ERISA. So they don't have those fiduciary duties, or do they? Anybody I know who's advising governmental plans and church plans will tell them, we think it's best practice that you follow these prudent rules, because that's the rules that the courts are going to look at, and they're going to say, well, we don't have law for you, but we've got this, so let's apply that. So if you think you're good just because you're not covered by ERISA, please pay attention to this. I think we've got some good rules that will apply. So ERISA fiduciary duties include the fiduciary must act solely in the interest of plan participants and their beneficiaries for the exclusive purpose of paying benefits and defraying reasonable administrative plan expenses. The standard of care, which is the duty of prudence, is that of a prudent expert. We're going to talk about that in just a minute in greater detail. Fiduciaries are required to diversify plan assets. And then there's a strange little carve out in this statute. I've never understood what it would mean, but it says, unless it's reasonable not to do so. I don't know when it's ever more prudent not to diversify plan assets, unless you believe that Apple will forever be going up and you are Apple. But I think diversification is the way to go. So fiduciaries must also administer the plan in accordance with the plan's terms and in accordance with the terms of ERISA and other applicable law, the Internal Revenue Code. There is an exception to the diversification requirement, and that applies to plans that have qualified employer securities in the plan or qualified real property in the plan as an asset of the plan, in which case they don't have to diversify those securities. That kind of makes sense, but that becomes the rub in cases that we're going to look at. So the next slide is the duty of prudence. So this one I think is really worth dwelling on and looking at for a bit. And I was trying to read it straight word for word because it's so important. And this is really the key duty that gets litigated over and over and over again. Plan fiduciaries must act with the care, skill, prudence, and diligence under the circumstances then prevailing at the time you're making this decision, that a prudent person acting in a like capacity and familiar with such matters, that's important there, familiar with such matters, would use in the conduct of an enterprise of like character and with like aims. So good faith actions are not enough. That's not the standard that we're going to be held by. This is a prudent expert standard, as noted by the phrase acting in acting in like capacity and familiar with such matters. So if a prudent expert is familiar with these matters, they will know how to act. And if you aren't a prudent expert, you either need to become a prudent expert or you need to retain one. And for this reason, lots of plans hire investment advisors. Lots of plans hire investment advisors. And it's important to note, though, that prudence is about the process. The information that is gathered or presented to the investment committee, the fiduciary's deliberations about the funds that they're looking at, and the decisions that they make. Prudence is not a crystal ball. It's not about seeing the future and getting the answer right. It's about looking at the standard and evaluating the investments now. Are they prudent now when we're making this decision? And fiduciaries will be judged on their prudence in making the decision, not on the outcome 10 years down the line, unless certain other things apply, and we're going to talk about them in a minute. It must be documented. And I say this over and over again, and I think everybody knows it, but I think it's worth repeating over and over again. If you don't document that you made a decision, that you gathered information, that you talked to important people who knew the information, and that you made this decision, and when you made that decision and who was present, then it's really hard when you get drug into court to get acknowledged that you did make a prudent decision. You can talk all you want about, well, we had a meeting, I'm not sure what date, but we did talk about it. It's not as persuasive as if you throw out the minutes of the meeting and the minutes show that you made the decision after discussing certain factors. And so keep your minutes. Those are important. I'm looking at Claire because she's the minute taker for our investment committee, and I'm ever very thankful that she's there. Okay, so in the economic downturn, this is the next slide. Yeah, that's the right slide. In the economic downturn in the mid-2000s, participants sought redress to get their losses covered. And Edison versus Tibble comes from this period and became one of the most important Supreme Court decisions on the duty of prudence. The history of this is that back in 1999, Edison International had a 401k plan, and they picked a range of investments to be the investments in the plan that allow participants to elect from those investments. It was 1999. A couple years later, 2002, they picked some more investments. They added to the investments. Those investments are in the plan. Come 2007, market's not looking so great. People are very concerned about their account balances, and a group of participants and former employees bring a case against Edison and allege that the fiduciaries breached their fiduciary duty with respect to retaining these investments. And their main claim was that the investments in the plan were retail share class, so that the class of investments that was maintained in the plan were the retail share class. And they alleged that it would have been more prudent had they evaluated that and determined that the appropriate share class would be institutional share class, because over time we gathered enough money in the plan that we are at the institutional share class level. Seems obvious, but it wasn't necessarily obvious to them. So the Edison countered, oh wait, these are time barred by Erisa's statute of limitations, which is generally 6 years. So at least the 1999 investments had been in place since 1999. So 6 years have passed, and see, presto changeo, we're not fiduciarily liable for that choice. We might be liable for the choice from 2002, but we're not liable. But the participants countered, oh no, you have an ongoing duty to monitor the investments in the plan. So let's go on to the next slide. So the Supreme Court looked at this and saw that, you know what, it's not in Erisa. There aren't regs that tell us what we're supposed to do. So they looked to the law of trust, and they found that trustees under the common law of trust had a continuing duty to monitor the trust investments and remove imprudent ones. And that duty is separate and apart from the duty to act prudently when initially selecting the investment. So they have two duties. There's the duty to select it prudently, and then the duty to make sure that what you selected continues to be prudent. And then the Supreme Court rules at the end, they said, a plaintiff can allege and succeed a breach of fiduciary duty when the fiduciaries have been alleged to have missed their duty by failing to properly monitor the investments, and that the period of time for this monitoring is within the 6-year statute of limitations. Well, most investment committees meet more regularly than 6 years. So every time they meet, they have an opportunity to monitor those investments, consider whether they're still prudent, and act. And so if they don't act, then that's a problem. Some key takeaways. Investment committees should meet regularly. It's really important, and it's very common now. I can't think of any client that I have that doesn't have a committee that has some regular meetings. And that they need to look at both the performance of the funds as well as their benchmarking, but also the fees that are associated with these funds. So this case was about the fees. It wasn't necessarily about the performance. It wasn't that that fund was a bad fund 10 years later, but that fund charged us too much 10 years later. And you could have done something that would have helped us as plan participants. So now we're going to go on to a current case from this year. For several years, many years going now, fiduciaries of 403B plans. And if you're not familiar with 403B plans, they are like a 401k plan maintained by a tax-exempt entity. So they have participant-directed investments, and participants can put their money in the plan, and employers put their money in the plan. And a law firm out of Missouri, I think, Kansas City, okay, their name is Schlichter, and they began bringing a whole host of cases against large universities. I think there were 7 filed within a week of major universities in the United States, and there have been many others filed. And they initially started with the universities that had the largest amount of money under assets, because that's where the big bucks is. But slowly this is going to move down, and they're following sort of the playbook that was created for challenging fiduciaries of 401k plans. So Northwestern University is one of the first group that was sued in this, and there were alleged breaches of fiduciary duties. So those breaches include current and former employees allege several Erisa violations, failure to monitor and control record-keeping fees. So not just the fees of the investments, but the fee that you're paying to the record keeper, whether that's Fidelity, Empower, TIAA-CREF, whatever. Failure to monitor, to make sure that when retail share classes are there, if you could use a lower cost class, and it becomes available, that you should use the lower share class. It's a higher share class, but a lower fund. And one of the allegations, which at the time seemed strange to me, because it said that they offered too many funds, and they had over 400 funds. So that wasn't uncommon, and still for some 403B plans is not necessarily uncommon. But they said it resulted in confusion and poor investment decisions. And I wasn't sure about that, but that becomes the key on this case, is not necessarily the investment decisions, but the number, just the number. So let's go to the next slide. The case was taken up by the Supreme, let me finish. I missed a slide in my notes, so I'm just going to tell you about it. So the lower court ruled that that they hadn't necessarily breached their fiduciary duty. It gets taken up by the Supreme Court and in this past term. And the decision came out earlier this year, I think in January or February. The court cited Tibble. You can go on to the next slide, I think. And explained that even in participant-directed plans, the fiduciaries are required to conduct their own independent evaluation to determine which investments may be prudently included in the plan's menu of options. That makes sense, but it was helpful for the court to say, if the fiduciaries fail to remove imprudent investments with the plan, it's reasonable that they have breached their fiduciary duty of prudence. Court said that. So just because you have 400 investments doesn't mean that you're going to get a pass. And that was what the lower court had said here. The lower court said, well, you got all these investments, but there's some good investments in amongst the 400. And the fact that there's 2 or 3 clunkers, that's okay. And the court saying, no, you have a responsibility to review all of the investments that you have and remove any that are imprudent. So some key takeaways from this. The next slide. In light of this year's Supreme Court's decision in Northwestern case, here are some key takeaways. Delegate fiduciary duties. If the plan says that the fiduciary is the plan sponsor and says nothing more about it, then the plan sponsor is the employer, it's the company, and the plan sponsor is basically represented by its board. If the board isn't reviewing the investments, they shouldn't be the one who's delegated under the plan to be doing this work. So delegate that work to an investment committee and populate that investment committee with people who are familiar with fiduciary duties and specifically with the duty of prudence and investments. And if they don't have that expertise, charge them with hiring an investment advisor to help them meet the Erisa prudent expert standard. Regardless of the number of investments, remove imprudent investments. Now, most of my clients have between 15 and maybe 40 if they've got a whole suite of retirement date, target date funds. But I don't have clients that have 400, but I do know that this happens frequently. And that, you know, it's very hard. It's very hard to monitor that number of investments. It's very hard to keep up with that. So pay attention to the fees. If there are similar funds with the lower cost, consider going with that. And if there are other funds in the same class of funds, but that are have a lower share class, a lower cost for the share class. I'm saying that wrong, but the plan should consider moving to the lower cost fund of that class. And so we will take, I see somebody raising their hand, and if you have a question, please go ahead and send the question through the Q&A on the Slido app, and someone can help you do that if you want to ask a question, and we will respond to the questions after at the end of the program. Okay. Stock drop cases. Fifth Third Bank, my first bank in Ohio. So Fifth Third Bank is a large financial institution, and they had a 401k plan that included an ESOP. Again, that's a section of the plan that is employer stock ownership plan, had employer securities in the plan. And in September 2009, a group of former employees and current participants in the plan filed a class action against the company as the plan sponsor and its corporate officers in their capacity as administrator of the plan, and alleging that they breached their duty of prudence because they knowingly or should have known that the company's stock was overvalued. The complaint alleged that the stock was overvalued due to the firm's over risky due to the firm's involvement in risky subprime lending, and that the officers made material misstatements in public about the company's financial prospects to inflate the value of the company's stock. The plaintiffs alleged that the prudent fiduciary acting in good faith would have removed the stock from the plan or would have disclosed this non-public information. And instead, the fiduciaries continued to invest in the stock, all the while allegedly knowing that the stock was overvalued. And that happened until the market crashed in July of 2007, according to the plaintiffs, wiping out 75% of the stock value and the account balances of the participants. So lower courts looked at this in the middle of this financial crisis going on, and these people have lost all this stuff, but they said, Erisa has a presumption of prudence if the employer has employer stock in the plan. So if we're dealing with an ESOP where the employer stock is in the plan, there's a presumption that the fiduciaries are prudent in retaining the stock of the plan. Now you can rebut a presumption, but the presumption is there. So the Supreme Court steps in and takes a look at this, and they reject this idea. They say there is no presumption in the statute. And if we go back to the first slide, please don't slip back. But if we go back, there's an exception to the diversification rule. It says you've got to diversify to reduce the risk of loss. And then the exception is if it involves employer securities. So you're not required to diversify the employer securities, but that doesn't change your duty of prudence. And the Supreme Court ruled that the duty of prudence applies to all plans, whether or not they include employer securities. So they dispensed with that argument. They also countered the argument that the fiduciary said that the stock was overvalued. And they said, well, looking at it, this is a publicly traded stock. And there's lots of ways to figure out what the value of a stock is, but this is a publicly traded stock. There's all kinds of disclosure out there. There's lots of information. And perhaps the best way of understanding what the value of a stock is what is the market price for a publicly traded stock? And so they got rid of that one too. They said, no, if it's a publicly traded stock, the fiduciaries can rely on the value of the market, and they don't have to prove that they do or do not know whether it's overvalued, because the value of the stock at the end of the day is what people are paying for it. Let's go to the next slide. In resolving the case, the Supreme Court highlighted the balance between ERISA law and securities law. And they kind of overlap in both places. The court ruled that the plaintiffs cannot state a claim for fiduciary breach by saying that they should have done something that is illegal. In other words, that they should have sold the shares of the stock that were in the plan because they knew that it was overvalued, because then they would be using insider information to trade in securities. And that's a bad thing. That violates the securities rules not to trade in insider information. And so the court dispensed with that. And then finally, the court addresses how lower courts need to evaluate these breach claims. I think it's helpful. It's confusing. I'm not sure that anybody could ever succeed on this standard, but what they wanted lower courts to look at is if someone's alleging a breach and it involves employer securities in the plan, and they think that the employer should either sell the stock or disclose the information because the securities are overvalued, the court reviewing this has to consider, would more harm than good be done by following that act? Would a prudent fiduciary actually have done that if the result of that would be the value of the stock in the market as a whole would collapse because the company's own investment committee is selling its shares, or if they disclosed what is non-public information to the public, then the value of the stock in the market crashes, and that means the value of the assets in the plan. So that they wanted future courts to do this balancing. And again, that comes up in the case that has just been issued. Let's go on to the next slide. From the Seventh Circuit. And this case involves Boeing aircraft and some more recent history, not as ancient history. But in August, the Seventh Circuit Court of Appeals ruled on a similar stock dock case, Burke v. Boeing. Boeing's 401k plan was again an ESOP. Therefore, it had employer securities in the plan. The plaintiff sued Boeing, the investment committee, and the corporate executives, alleging that the leadership knew about potential issues with Boeing's 737 MAX planes as early as 2010, long before the stock plunged after the crash of two 737 MAX planes and the FAA grounded the planes. So the plaintiffs alleged that the fiduciaries had breached their duty of prudence, their duty of loyalty, and their duty of ongoing duty to monitor the investments. And Boeing responded, it's not applicable to us because we, back in 2007, transferred the responsibility for the stock fund to a separate independent fiduciary. They hired a third party, independent fiduciary, to manage the ESOP portion of the plan. And that independent fiduciary is not an insider, did not have access to this insider information. And therefore, as a result of this, we didn't breach our duty and they didn't breach their duty because they didn't know. So that was what they said. And the Seventh Circuit pretty much agreed. Let's go to the next slide. Is this the second slide on that format? Yes. So the court found that Boeing's defendants were in fact not the fiduciaries for this stock fund, and that independent fiduciary was managing the fund and therefore was responsible for whether the fund was retained or the shares were sold. Leaning into the balancing issue between ERISA and securities law, the Seventh Circuit noted that independent fiduciaries can serve a valuable and legitimate purpose for managing the tension between ERISA and federal securities law. Some key takeaways. If you've got an employer stock fund in your plan, consider appointing an independent fiduciary. You're not required to, the law doesn't require it. Nobody says you have to do it, but that, this was the get out of jail free card for the Boeing fiduciaries because they were independent of that decision. Also, review both the prudence and then the balance with respect to federal securities laws and try to look and see how those are going to be balanced by courts as you make your decisions about retention of employer securities. So finally, we're going to go on to new auditing standards. It's audit season. Lots of employers that have calendar year plans are speaking with their auditors right now and finding out that the auditors maybe have want more information and some certifications from the plan administrator itself. So there's a new auditing standard that significantly changes the form and content of auditors' reports and financial statements. Most significantly, it affects what plan fiduciaries, in other words, the plan administrator, is going to have to do. They're going to be required to take some additional steps when they have what used to be called a limited scope audit, but is now referred to as an ERISA 103, section 103A3C audit. I'm going to dump all those letters and just say 103 going forward. So in general, all the way back to the beginning of ERISA requires that plan administrator has to file an annual return. And we call that the 5,500 every year. And that applies to ERISA covered plans. And If the plan is a funded plan, then and has a certain number of participants, that annual return has to be accompanied by an audit. And the requirements of Erisa say that the audit has to be done by a qualified independent qualified public accountant on behalf of the plan. And that qualified independent public accountant is supposed to review the financial statements, books, and other records, and anything else they need sufficient so that they can make a determination and have an opinion on the financial statements of the plan. So Section 103 provides that an auditor need not, so they have to look at everything, but they get a carve out. They need not address any statement of information regarding the plan assets held by a bank or similar institution or an insurance carrier that is regulated by a state or federal agency if certain conditions are satisfied. So that's helpful. And that's what's called the limited scope audit. All along, people said, well, we've got this statement from our bank, and it says we have all these assets, and here are the trades and whatever, and they've certified it. And so as a result, you don't have to look at that. You know, pay no attention to the man behind the curtain. And so that was good, but that hasn't always been how it has worked. And AICPA, and I don't know what that acronym means. I think maybe the American something of Certified Public Accountants, in their guide about how to address this, make note of the fact that a lot of the information that's supposed to be in some of these has been found to be erroneous. So people got a statement from their financial institution, handed it over to their auditors and said, look, limited scope. But then when somebody went back and looked at it, some of them weren't accurate. They didn't have the right information. We're going to talk about what that is. So the regulations provide that the insurance carrier or other organization, bank, or trust company, so the broad group of financial organizations that hold the assets of the plan, shall certify to the accuracy and completeness of the information described in their report that's required by Erisa, and have a written declaration that's signed by a person who's authorized to do so and represents the insurance carrier or bank. Such certification will serve as a written assurance to the truth of the facts stated therein. For over 20 years, the DOL has been telling people that plan administrators have an obligation to have complete and accurate returns, the 5,500, and that obligation includes that they need to determine that the thing they got from the investment company, the bank, or the insurance carrier is accurate and satisfies the requirements of Erisa. But generally, nobody was really looking at the plan administrators and asking, does it really satisfy this? This year, the auditing standards changed, and now we're looking at the plan administrators and they're saying, please tell us, does this satisfy the requirements? So let's go to the next slide. So what the plan administrators have to do is a little bit straightforward, but often feels confusing. And so I've boiled it down to some bullets. There's a much longer report, which we would not go into, that AICPA has issued and asked for the plan administrators to certify this. But the certification that they received from the insurance company or the bank, trust company, the plan administrator has to certify that that is a qualified institution. So you didn't get it from your record keeper who isn't holding the money. You got it from the bank or the trust company or the insurance carrier. So that's first point. Second point is signed by an authorized representative of the qualified institution, not Bill in charge of the mailroom, but Sue in charge of the trust section of the bank. And how you know that is that's what it'll say. When you look at the cover of the sheet, it'll say, Sue signed this, Chief Operating Officer of the trust company. does not include any language that would call into question whether the certification meets the requirements. And basically, that's the hedging language that people put in the document, where they're saying, we've reviewed all this and it's accurate except for A, B, and C. That calls into question whether this actually meets the requirements. So that one's a little harder to look at, because these documents can be 300 pages long, but a lot of it is numbers. It's the hedging language you want to look for. Plan administrators must also determine whether the period covered on the certification matches the plan year. So we're going for an audit for the 2021 plan year. So the certification should say we're certifying for the January 1, 2021 to December 31st, 2021. The valuation date is correct. It says we're evaluating this on the last day of the plan year, December 31st, 2021. If it says we valued it in August, maybe that's not the right valuation date. And then finally, they want an analysis of whether the valuation method is appropriate for the assets held. So generally, if the assets that are held are publicly traded securities, if they're the funds, the investment funds that are available on the market, the valuation method should probably be, what is the market value on the date of valuation? If you've got other fun and interesting assets in your plan, you'll need to find somebody who can make clear that the valuation method is appropriate. So, my takeaway on that is really, if you have questions about it, please feel free to call us. We'd be happy to help. Also, if you have an investment advisor and you have questions about the valuation and want somebody to look at that report, go ahead and call your investment advisor. It shouldn't be onerous, but it is more. It is more than has been required in the past. So that's the end of this. And now my colleagues are going to come up and answer some questions that you all have submitted. And if you have more questions and haven't submitted them, please go to Sligo. And there's the information on how to do that. And we'll be addressing them as time permits. Be sure to include your first and last name or your email address. So if we don't get to the question, we can respond to you. I promise we will not call you out by name in our responses. And while you're typing last minute questions, I want to take a minute to cover two additional offerings from Williams Mullen. First is the brilliant podcast by Brydon Dewitt. It's the Benefits Companion podcast. And he has interesting guests who come and chat with him about important issues involving retirement plans and health and welfare plans and executive comp plans. And you can download the podcast at these organizations that are listed at the bottom of the slide. And the second thing is our continuing legal education webinar that is coming up in October. Here's the slide, shows you the dates. And the program has been approved for 4 hours of continuing legal education credit in the states that are listed, including Virginia, North Carolina, and South Carolina. If you're interested in registering, you can go to the events page at the firm's website and register there. And now let's do some questions. Who's going first?
I'll take one. There's a question as to whether there have been any private letter rulings after the 2018 private letter ruling on allowing or having plans match student loan repayments. And I'm not aware of anything since 2018 that there's been any other private letter rulings. And if there were, again, those rulings would only apply to the taxpayer that requested the ruling. So we really need, if this is going to be something that employers can feel confident about implementing, we really need the Secure Act 2.0 to have that legislation enacted.
Sure. So I've got one question. Do most companies vest immediately in their 401k? I would say typically no. If they're having a match, there is often going to be some sort of vesting schedule. You will see maybe a portion of that can be vested immediately up front, but there's often going to be a vesting schedule associated with it. It can vary though in length, depending on if they want them to vest fully after 2 years, or if they want to do kind of a gradual vesting that will occur.
There's a question about whether the prospect of the Secure Act passing this year. From just news reports that I'm reading, there was a lot of activity last month in Congress of trying to get this passed. There's an expectation, I guess, that it would be passed this year. But there's broad bipartisan support. Again, the legislation passed over 400 votes to 5 in Congress earlier this year. So I think it's hard to predict, but I think there's a good chance that we could get some legislation this year.
So is that all your questions?
We have a few more unless you want to jump in. And...
Yeah, you can go for a few more. I have 4, but I'll let you.
So we have one that I think Brydon and I could both take a stab at with student loan match, and whether or not I think employees would be concerned about having to share additional data points, which I think is a fair question, right? I mean, you share a lot of personal information with your employer. Do people really want to share more? And I think to a degree, it may depend on what your match is, right? On those. So this is talking about for student loan matching programs, or with Secure 2.0, allowing you to add a match for the 401k relating to student loan repayments. That I think it's going to depend on what the benefit is, but at the same time, it's free money for employees. And so whether they use it or not, it still would be a great opportunity for them to be able to contribute to their savings when they may not be able to contribute to a 401k because they have to pay back these loans.
Yeah, I hadn't thought about that before, but it may be a plan drafting issue. So if your plan language simply says that student loan repayments are matched, and you're not matching the student loan repayments on the ones you don't know about, you might technically have an operational error. So the plan probably, and we'll have to see what the legislation says and if there are any regulations and guidance, but I would think the plan would need to say that the plan matches reported, or that student loan repayments that are reported and verified by the plan to and verified by the plan administrator, or some language, because it's kind of like the automatic enrollment issue where the plan administrator doesn't know that 5 employees were hired and they weren't automatically enrolled, and then you have an operational failure. You could have operational failures depending on how you draft your plan around the student loan match.
And then I'll just add one more because we have a question about stretching your match with a 6% match, so then we can kind of get away from matching on there. But so for 6%, you can often see stretching that out where you pay perhaps 50 cents on the dollar for your matches going that direction. So once again, an employee would end up deferring up to 12% of comp to get the full 6% match on that front. I mean, there's wiggle room for all of these, whatever you think works with your organization on this front as well. But
so I have a couple questions. There's one here from somebody who actually told me who they are, and I will respond to them directly by email because I am not familiar with the particular issue involving a particular company's target date funds. So I will get to that later. But one question is, do you recommend committees summarize annual retirement plan actions to their board given their personal liability? Yes, I do. Because the board, if the board effectively delegates the authority to the committee, then the board doesn't lose all responsibility. The board has a duty to monitor that the committee's doing their job. Board doesn't need to know everything they did, every decision that was made, but there is an obligation for the board to know that they are meeting, that they have met with somebody who maybe is an investment advisor or whatever action they needed to take. Then if the committee reports, especially they report back in writing to the board, then the board can check their box. We know that the committee they met 5 times this year, and these important decisions were made. So yeah, I do think reporting to the board And it doesn't have to be long, but I do think it's a good idea. How is the duty of prudence applied to 401k plans with self-directed brokerage accounts, and the investment is a self-directed brokerage account? And so for those of you who may not know what self-directed brokerage account is, that's a plan that allows employees, participants, to select something beyond the actual investment selections that are in the plan and go out and pick individual securities or funds that aren't part of the plan's array. That is a big, huge black hole that, with respect to Erisa fiduciary duties, because I'm not aware of any litigation that has happened on this. But supposedly the fiduciaries are going to be reviewing these investments, but they can't review every investment that's available through a brokerage account. So we don't really know how this is going to play out. I can say that I'm not aware of any litigation, but I don't know that that means that maybe the fiduciaries have an obligation to do some training, participant education, for people who select the brokerage account, talk to them about, require that they go through a training on diversification or something, so they don't put everything in McDonald's. Not that McDonald's is bad, but that might not be, a prudent decision. So, I think that it's a black hole with respect to whether or not courts would hold anybody liable for participants' selections of funds that they affirmatively got to go and make. But we don't know. There's a final question that has to do with the cybercrime and DOL security over cybercrime issues. And I do not have enough information to really give a great answer on that. If the person who sent that in wants to send their email, I did read 2 articles about it and a case. So I'd be happy to share, talk about that with you directly. So I think that's about all the time we have for questions right now. And if we didn't answer your question, we'll go ahead and reach out to you if you gave us your information. As I mentioned before, please keep an eye out for an email later today, later this afternoon. It'll have links to the presentation materials and the recording of our program, as well as the information about SHRM credits for our remote attendees. Please also look at that email. It'll contain a link for a survey. And those of you who are in the room, you can fill out your own surveys to give us some feedback on today's program, which we'd love to hear. Feel free to reach out to any of the speakers if you find you have any additional questions. And thank you so much for joining us, both those who are online and those of you who are here in person. And have a great day. Thanks.